Hi everyone, in this video I'm going to take a deep dive into Disney's latest earnings call to try and decipher what's going on with Disney's stock. So let's get right into it, starting with CEO Bob Iger's opening remarks, and I've highlighted here a few things. First, it's a major strategic reorganization. They're going to change it into their business into three core segments, which will be including Disney Entertainment, ESPN, and then Disney Parks. So three different segments, including ESPN, Disney Parks, and Disney Entertainment. Now, there has been some speculation because of this change that Disney could be entertaining a sale of ESPN, and certainly by splitting these up into three different segments, that would be easier to do, although there was no news of a pending or any discussion of that in the opening remarks of the earnings. So one of the other things that came out of the earnings call was this major announcement here. The company's going to run their business more efficiently, especially in the challenging economic environment. In that regard, we are targeting 5.5 billion in cost cuts across the company. Reductions to our non-content costs will be roughly 2.5 billion, not adjusted for inflation, and 1 billion in savings is already underway. So that's good news for Disney stock investors that the company is prioritizing profits and targeting cost cuts, which will include reducing their workforce by approximately 7,000 people. On the content side, we expect to deliver approximately $3 billion in savings over the next few years, excluding sports. So these cost cuts on content are going to be non-sports related content, which just goes to highlight how valuable the sports content is to Disney and ESPN. Um, this was another big highlight where CEO said, "We will no longer be providing long term subscriber guidance in order to move beyond an emphasis on short term quarterly metrics. Our current forecasts indicate that Disney Plus will hit profitability by the end of fiscal year 2024." So by the end of the next fiscal year, Disney Plus should be profitable. Now, this was a big move away from the long-term target that Disney had gave investors, telling them to look for over 200 million Disney Plus subs by the end of 2024. It looks like they're kind of brushing that aside, not saying we no longer think we're going to achieve that or reducing that target, but rather just saying we're not going to talk about that target anymore. So that's interesting, and that comes on the heels of the changing investor enthusiasm, right? Last year and the year before, investors rewarded Disney based on subscriber growth, right? Every time they reported robust subscriber growth, the stock price would soar higher, regardless of what happened to profitability. Investors were laser focused on subscriber growth. And so Disney was incentivized to spend aggressively in creating and building out this subscriber segment and just adding subscribers without focusing on profitability. In recent months, investor focus has changed from just thinking about growth to now thinking about profits and cash flow. And now that the investor focus has shifted, Disney's stock price had retreated and the subscriber growth numbers were no longer delivering the stock price growth that they were in 2021. So Disney had to change its focus to now focus on profitability of the segment. They recently instituted a price increase in their Disney Plus service and added an ad-supported tier to again support revenue and profit growth and not just focus on subscriber growth. And I will end with these final comments. The CEO saying that they're going to focus even more on the core brands and franchises which have consistently delivered higher returns. They're going to aggressively curate their general entertainment content. So what this means is folks can expect more Marvel content, more Star Wars content, more Pixar content, more of the content from these proven iconic franchises that consistently deliver excellent returns on investment, and less general entertainment investment, less on shows that you will find on Hulu most likely. So less investment on those types of general entertainment, which the CEO said is not differentiated and doesn't necessarily deliver a acceptable return on investment. They're also adjusting their pricing strategy and a full examination of their promotional strategies. And this may include greater use of legacy distribution opportunities to increase revenue and more effectively amortize content investment. In other words, you may start to see more Disney Plus content showing up on its legacy distribution channels. So you might see The Mandalorian show up on the Disney Channel or show up on ABC. Now, that's my speculation based on what the CEO is saying here, but those are the type of things that investors can and viewers can look ahead to, is more of Disney Plus content showing up on the legacy cable channels to kind of reach a different audience and spread out those cost of content investment across different channels. All right, so that's all I've got for this video. As always, I truly appreciate your viewership. Thank you for stopping by, and I hope you'll see me next time for another video. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.